So, hello everyone. I'm here with Lars Nielsen, who is the Director and Senior Product Specialist at Pyrford International, an investment boutique that operates independently within Columbia Threadneedle Investments. Lars has an overall responsibility for all the client-oriented activities, and he has more than 25 years experience in the asset management industry. Today, we wanted to chat to him about Pyrford's Global Total Return, to learn about the investment philosophy and the strategy behind the fund. So, as an independent investment boutique with more than 30 years of experience in the investment industry, what are your views on the current situation of the market, and how is volatility and inflation affecting your investment process?
Yes, good morning, Patricia. Well, at some level, I guess times are very interesting. It's very volatile out there at the moment, but at some level, that is exactly the way the world always is. So I think having been through many of these cycles before, I think we're looking at this really as we look at the markets all the time. We think it's very important to have a disciplined approach when we're looking at markets. So when markets are volatile, when there are inflation fears, that is at some level just what we would expect on any normal day. And we are using our tried and tested process, which looks at the fundamentals and really tries to take the noise out of the analysis.
So, coming to that again as well. So the main goals of the Pyrford Global Total Return Fund are preserve capital, beat inflation, and deliver returns characterized by low volatility. So on that note, how is the current situation of the market affecting the strategy, and is it making it more difficult to reach those goals?
Yes, I think in many ways, and maybe had we spoken a few months ago, this would probably have been an even more challenging conversation. I think at some level, markets have been very challenging for us for a long time. Our starting point is don't lose the money, and that is the capital preservation. That's what rule number one. Rule number two is see rule number one. So don't lose the money. And the reason we're so focused on that is that if you have a big drawdown, you need to work very, very hard to get back to where you were before. So, you lose 30% and make 30%, you're still down 9. So not losing money is really, really important to us. Now, given where markets were, we think both equities, bonds, real estate, every asset class was very, very expensive and has been for a number of years now. And the reason for that was an unprecedented printing of money that really started back in 2009, but was then obviously vastly expanded when the COVID virus hit in 2020. So these are interesting times, I guess, and very difficult to find good value. We are quality and value investors, and looking for that is very difficult in these times. And at some point, we actually find ourselves sort of hiding in the cave, if you like, trying not to lose money while we're waiting for opportunities to buy assets.
That's really interesting. And going again to your investment philosophy, how would you describe it? And would you say it has been steady over the years, or did you have the capacity to adapt with the times?
So our investment philosophy has never changed. We're foremost long-term investors. We're very conservative. We're very focused on capital preservation. We very much believe in fundamentals. So we believe in buying good assets at reasonable prices and then just holding them for the long term and avoiding big drawdowns. So we're long-only investors. We don't short anything. So we're not like a hedge fund, and that's not because there's anything wrong with shorting. It's just that we think that you get hostage to market movements. So we're very much long-term investors. We find good assets, we hold them for the long run, and then do a lot of work looking for new ideas, and that's really all we do. And it's very much a fundamental approach, very low volatility, very low risk. Try to avoid the traps out there and not get excited when something new comes along. Very much focus on the fundamentals.
So I wanted to talk a bit about adaptability, but obviously you said that you have kept the same strategy for all this time. So how did you do it? So in 2008, you delivered an impressive 12.8%. What did you do, and could you explain the key factors of?
Yes. Well, the underlying building blocks we have are really, and we talk about these four factors, but so with the underlying building blocks are just global equities, predominantly developed markets, high quality government bonds, and then an element of currency management, and then also stock selection. These are sort of four drivers of returns. And what happened in 2008 was that we got all four of them very right. And when you get all four of them very right, we will make a very good return. Now, in a normal year, we will probably get one or two of them right, and one or two of them are not going to do an awful lot. Now, in 2008, if you think back, as we came into the financial crisis, we were very concerned about leverage around the world. We thought asset values were very high. So we had a very low weighting in equities. So that was sort of take number one. We didn't have a lot of equities coming into the falling market. What you also had in 2008 on the fixed income side was an opportunity to buy long duration assets. This might sound a little bit like fiction, but you could actually buy high quality, long duration government bonds with a sort of real yield of about 5% at that time. And that was just a tremendous opportunity to buy in a number of markets. And we did that in the fall of 2008, as effectively there was a financial market meltdown. When the financial sector and banking sector melts down, that is incredibly deflationary. And so we thought we should be in the longest, highest quality nominal asset that we could find. So we were in long, bunds, US treasuries, or what have you. And that added a lot to our returns. The third thing that really helped us was that we were counting in sterling. Obviously, sterling fell against the dollar from over 2 to the dollar to something like 1.35 in May 2009. And so that helped us a lot. Actually, by May 2009, we took all our foreign exposure in the bond market off. So we effectively went back to being almost entirely in sterling. And then finally, stock selection. Our companies did tremendously well in 2008. And that's exactly what we would expect. The stocks we own will do very, very well in difficult markets. And we're seeing that right now. We are outperforming significantly in our equity portfolios because our companies are not participating in these big falls that you're seeing in the more speculative parts of the market. So really, in 2008, you had all four things came together and helped us, and so that's the reason we had such a good year. Now, I wouldn't predict that we were going to see double-digit years very often. We do see them from time to time. The other thing that's, I think, much more important is that we will never deliver sort of minus 20% in a year. And I think that is actually, we're more proud of the fact that we've only had 2 negative calendar years over the sort of more than 20 years, 25 years that we've been running this strategy. We think that's actually a much bigger achievement than the fact that we made 12.8% in 2008.
Well, it's indeed very impressive. So you mentioned your 4 key return drivers, and so why do you believe that they are so important to the strategy of the fund?
Well, we like to use those to describe what it is that we're actually doing. And the 4 drivers are, the first one is really asset allocation. And there we're really talking about how it's a simple strategy, so it's really about how much should we have in equities. Over the long term, equities will be the best performing asset classes. I mean, I think there's broad consensus that that's the case. It's because of the risk you take. So generally, equities will do much better than all our other asset classes over the very long run. Now, so why don't you just buy equities, right? The reason that people cannot just buy equities is that you have to be able to survive and be able to hold through some pretty nasty times. Equities can pull down, once every 10 years, they probably pull down sort of 20, 30%. So you got to be able to live through that. So if you're not able to, I guess a different way of saying that is that if you buy equities when they're cheap, you can make good returns. But if you buy them when they're expensive, you're at risk of having to wait a very long time before that return comes through. So the first thing we look at is how much should we have in equities? Now, equities generally have been quite expensive, so it's been very few and far between that we've been able to buy equities. The last time we were able to buy equities were actually in 2020 as the COVID pandemic hit. we actually went out and started buying equities as markets were falling incredibly dramatically. And that was a pretty good opportunity. Subsequently, we have actually taken that a little bit lower from the weight we had in 2020. Now, the other thing, so there's a sort of the second driver is that when we don't own equities, but we have to own something else. And we like to own something that does not perform like equities. And that's the reason we use high quality sovereign bonds, because that's the only asset class that we think really performs differently than equities. If you think back to 2020, corporate bonds, high yield bonds, they were all falling tremendously quickly. And so the opportunity to switch out of that asset class into equities is not really there, not to mention that you might not be able to sell it because of liquidity. Liquidity is another very important factor to us. So high quality sovereign bonds tend to perform when equities are falling. They tend to hold up much better. So that's what we use. And they are really all about duration. Unfortunately, for the last sort of 10 years, there has really been no value in long duration bonds. So we've had to hold some short duration bonds and effectively protect against, if markets were to fall. So it's a sort of buffer we have. The third driver for us is currency. Now, we think it's incredibly important that you take into account the base currency that you're managing a strategy from. For us, that's sterling. Obviously, for our European clients, we then have a hedged version into euros, which just moves the returns into euros. But our sort of formal management currency is sterling. And what we're really looking for there is that if sterling is expensive, well, then we want to have exposure in other currencies so that if sterling were to fall, we can make money. If sterling is cheap, we want to repatriate and have very little overseas exposure. And so we vary that. And that came, for instance, when we had the Brexit referendum. That was time when it was very important that we had about 40% overseas exposure at the time, and that helped us tremendously in 2016. It was not that we had predicted Brexit; we were just simply looking at the fundamentals that said that sterling needed to fall. And the final selection, I guess, is stock selection. We are not believers in passive stock selection. Passive stock investment. We don't think you should just go out and buy a broad index. We think that the kind of companies we own are high quality, very good balance sheet, good management, very sort of solid business models. These are the companies that will hold up well in a down market. Now, when markets get very excited, these will tend to lag behind. But we think that very good downside capture that we get when markets fall is actually another contributor to the way the strategy performs over time. And we've seen that again and again. And in fact, we're seeing it again this year, where some of our very solid UK businesses are actually up year to date in 2022, and they're helping us deliver a positive return so far this year, where most other asset classes are down.
So, continuing with the strategy of the fund, how would you describe your asset allocation process?
Yeah, so it's a very fundamental asset allocation process. It's a competition. We generate our fundamental numbers once a week, and then we have an investment strategy committee of the foremost senior people that sit together and discuss, and they will then allocate between equities and bonds. They will decide what duration we should be in, currencies, and what countries we should be in. Now, we are not making big changes very often, but it is effectively a weekly refreshment of numbers. What we're looking for is a simple competition. What you get from owning equities is that you get a dividend yield plus a growth in earnings. What you get from fixed income is you get a coupon plus potentially a change in the yield curve. So those are the components we are competing these asset classes against each other. And what we're simply trying to do is put the money where we think there's the best opportunity for our clients to have some return. Now, at the moment, many things, as I said, look very, very expensive. So it is a little bit of a, least bad kind of competition, where we end up having, relatively low exposure to equities, relatively short duration in our bond portfolio, because we simply think that protecting capital here is important, because we think there's an awful lot of opportunity to lose money, and have thought for a while, and therefore we're keeping a lot of powder dry. But we're ready to move. As we saw, we moved 15% in the equity weighting within a week in 2020. So we added
Mhm.
15% percentage points to the equity weighting in 2020 in March.
And so, do you favor any sectors or geographical areas among others?
So it is a global approach in terms of the
Okay.
equities. In terms of equities, we have for a long time and still do prefer Asia ex Japan. We
Okay.
think that's an area, a part of the world, and forget maybe about COVID, but it's certainly a part of the world where you just have much better fundamentals, much better demographics. Companies get much better productivity growth. There's just a fundamentally sort of following wind in those markets. Asia is where most of the world population lives, but if you look at the market cap of the listed sector there, it's a very small percentage of the world. We think over a long period of time that will come closer to being similar, and therefore we think the markets in Asia have a natural way to grow. So Asia ex Japan, we have been overweight in all our products for probably 20
Okay.
years, and really since sort of the Asian crisis back in '97, where they had just gotten a little bit ahead of themselves. But we think there's a following wind for those markets.
And compare with the index, what sectors are you overweight and
So
what
so
sectors
we
are you
Yeah,
underweight?
so we don't really look at sectors a
Okay.
lot. So sectors is a fallout from stock selection, but I guess I can mention European banking as a sector
Okay.
that we're not in. I do realize that in the last maybe year, European banks have actually done pretty well. We think they still have a tremendous amount of problems. We still have effectively negative interest rates, although that could be about to change. So we haven't owned a European bank for more than 10 years. And over that period, there's probably been 3 or 4 times for about 3 to 6 months where it felt a bit uncomfortable. But we think that the structural headwinds for that sector are still very, very bad. So that's a sector we don't like. Generally, we like to find businesses that generate a high return on equity, pay out a good dividend, have low debt on the balance sheet, and have very predictable earning streams. So we do like things like Nestle, where they can just compound a great rate of return over years and years and years, and very well driven businesses.
And what do you look for when you are choosing an asset to invest in? And second question, do you have any red lines?
Well, so I've sort of already alluded to what we're looking for in terms of equities. We're looking for those very stable business
Hmm.
models, high barriers to entry. I guess we can say that we like oligopolies. We like companies that don't have to compete too hard against people that are irrationally competing against them.
Hmm.
So that's sort of I think that sort of business model we're looking for. And then it's really about just kicking the tires and visiting these companies and make sure that we don't overpay for them. And then we go back and visit every year to make sure that nothing has changed. And we talk to management a lot. In terms of red lines, we do not apply any sort of screenings or anything like that. So it's not like we exclude anything. The only thing I guess we exclude is that we will not own stocks that are very illiquid. So liquidity is something we're very keen on. We want to be able to get in and get out. Now we
Hmm.
do obviously consider things. I think it would be a big red flag for us if we found child labor or something, or
Hmm.
asbestos or whatever. And that's really not because, and I don't want to sort of sound like a total cynic here, but it's really because that is really poor for your long-term returns. So you really don't want to have companies that end up on the front page of the AFT,
Hmm.
having been engaged in some business practice that they shouldn't. Um, so we take all these things very serious, but it's not a red line that we wouldn't invest in. I think the things that we're probably more worried about would be over leverage. If a
Okay.
company uses way too much leverage, then that is a red line for us that we wouldn't invest in. So there are some more fundamental red lines, I guess. And then industries that are very ill-disciplined, maybe steel producers or something, where you just
Hmm.
tend to get money flooding in. Even if you find a good company, money will flood in to other companies, and they'll just overinvest, and it's a very rough cycle that we're not so keen on.
And going to the last question, I understand that it's not an ESG fund, but do you still take in consideration some of the ESG principles during your investment process?
Yeah, so I would say that in some sense we have always been ESG investors in the
Mm-hmm.
sense that there's obviously three letters in there, but in terms of governance, we've always thought that was incredibly important. And now, over the last sort of 20 years, it's gone from one where governance was very important, and we looked at it and we voted every proxy, what have you, to a much more formalized ESG process that we apply. So we use external sources, and they help us effectively with ratings on all the stocks that we own. And then we also actually do our own. We charge our portfolio managers and analysts with rating every company we own with an absolute kind of score in terms of where they are on an ESG, based on about 10 principles, and that's a score between 1 and 5. Now, we do not exclude companies, but we score reasonably well on ESG. Now, we do own some types of stocks. We tend not to score well on an ESG rating in an absolute sense, something like tobacco.
Mm-hmm.
Which would actually score well on these external scores because they score them relatively. So they use a slightly different methodology. We do issue every year an ESG report. So we do actually do a fair bit of work and have been doing now for about 5 years. Fundamentally, we think ESG is incredibly important. We are responsible owners, so we want to make sure that these companies are doing what they're doing as best as they can while they're making returns for our clients, that they're actually doing the right thing. We think they actually kind of go together. If they do the right thing, they tend to make more money in the long term. The way we think ESG should be applied is through engagement. So we don't exclude anything because we actually don't think it really matters. If we were to sell, I don't know, any stock,
Mm-hmm.
they probably wouldn't really notice. Whereas if we actually meet with them once a year, we are actually able to put something on the agenda with them and say, what are you doing about, I don't know, reducing your carbon footprint or whatever it might be that we're looking at today. And that is an important process that we're in. And this is something we are going to get better and better and better at every year. We are also obviously signatories to the United Nations principles, et cetera, et cetera. So yeah, it's something we take it serious, but we are not promoting ourselves as an ESG fund.
Okay. So yeah, so we got to the end of the interview. It's been great chatting to you, Lars. Hope you have enjoyed as well the interview.
Yes, absolutely.
And yeah, it was amazing to learn more about the investment philosophy and the strategy of the fund. So thank you so much. And for anyone viewing us, thank you so much for being here with us today.
Yeah, thank you for your time this morning, Patricia.